Good evening and welcome to APPNA webinar Ask the Expert. Our topic today is financial implication of COVID-19 as physicians to their practices as well as 501(c) organizations such as ours. The havoc of COVID-19 continues. The number worldwide confirmed cases 14.3 million with 603,000 deaths. In United States, confirmed cases 3.7 million and 142,000 deaths. In Pakistan, confirmed cases 263,000 with 5,568 deaths. Before I introduce our special guest and panelists, we are going to get an update on APPNA ongoing relief efforts. For that, we have Dr. Asha Zafar, who's the Chair, Social Welfare Disaster Relief Committee. So, Dr. Asha Zafar, please go ahead.
Thank you, Ji. So, Dr. Sajid Chaudhary, who was the chair of the COVID committee, was not able to come this evening. The update I wanted to give was that since we have last talked, we have had a pretty good response as far as the fundraising is concerned. We are close to $1.1 million as far as our funds are concerned, although most of these have been dispersed. We have sent around $475,000 to Pakistan. $375,000 has been utilized in USA. Mostly at this time, we are focusing on the oxygen project, which was actually done to honor Dr. Rubina Anayat, and we've had a good response in that fund as well. All over Pakistan. The most that's given at this time is in Karachi. We're also doing it on all other bigger cities, including Lahore, Rawalpindi, Islamabad, Quetta, Peshawar. We are now moving the focus towards the smaller towns where the need is bigger, but it's difficult for a lot of the NGOs to access those places. So in this, we have been collaborating with Al Khidmat. Also, there's another organization called HANDS, which is very active in Islamabad as well as in the Rawalpindi area. The other focus is on PPE, which for a while had actually slowed down both in USA as well as in Pakistan. In USA, the hospitals have now started providing PPE to a lot of places, but in Pakistan, the situation is still not that good. We have covered a lot of areas in Punjab. Yesterday, the distribution was done in Balochistan. That was done in Bolan Medical College. Today, they will be moving further, which is the DHQ hospitals, which are in Turbat area, Laura Lai, and also in Chaman. KPK is another place which has been getting the PPE recently. We have had issues with Sindh in the inner Sindh area. Karachi has actually had a fairly good supply of PPE, but in the inner Sindh area, it has been a challenge. We worked with SANA, which is the Sindhi Association of North America, and they have provided PPE to areas like Mithi, also in the Tharparkar areas. The alumni, which is LMC, is now will be distributing funds for food as well as for PPE in these areas. So this is regarding PPE. For a while, we held back on the food since it appeared that the bigger requirement was more for oxygen as well as for PPE. But more recently, we have again started distributing food. We are getting a lot of requests from the Azad Kashmir area, since that is again pretty remote and there's not much help which has gone there. So we would be doing that. I again want to give the message to the membership that we are still matching funds when it comes to food. It's 50 cents to $1. We are not matching funds for PPE since it appeared that the situation in USA had improved, and also in Pakistan because the PPE is now being locally produced and the rates are actually much better. So this is basically the update. I just want to thank all the donors, the executive committee, the board of trustees, especially I want to thank Dr. Sajid Chaudhary, who has remained very active and he continues to provide all the updates. And again, special thanks to Nick and to Mr. Lake Siddiqui, who have been really supportive as far as getting our updates and our emails out. So thank you.
Thank you, Asha. Thank you very much. And we also want to thank you, Asha, for taking the lead with Sajid Chaudhary and you. You have done a tremendous job in relief efforts. Thank you very much for your
Thank you.
services. Now we move to our second portion. First, let me introduce you to our panelists. Dr. Nadeem Qazi, he's a gastroenterologist. He's a secretary of Arizona Medical Association, past president of APPNA, past chairman of APPNA Board of Trustees. He's vice chair Public Health Committee, Arizona Medical Association, and he's an advisor of APPNA Finance Committee. My second panelist is Dr. Masood Akbar. He's an head and neck surgery specialist. He's a member of APPNA Lifetime Dues Investment Advisory Committee. He's a member of APPNA Finance Committee. And my third panelist is Dr. Shahid Usmani. He's a pediatrician, chair of APPNA Lifetime Dues Investment Advisory Committee. He's co-chair Finance Committee. We have two special guests today. Hank Bashor, he's a senior vice president, Stevens Incorporated. He heads a private client group. We have Shiraz Iftikhar. He's a managing partner, Arch Global Advisors. Thank you very much all for coming. First, I'm going to ask Dr. Nadeem Qazi to give a brief perspective of how the physicians and their practices have been affected by this COVID-19. Dr. Qazi.
Thank you, Harun. We are all going through a rough time due to COVID pandemic, and every one of us is suffering. The only good thing about it, we are all in it together. In past, financial issues occur because of banking or loan companies. This time, this is different. So I'm hoping we will all emerge together at the same time. There's an organization called Multi-Group Management Association. They have done studies, and 97% of the practices has experienced negative financial impact, either directly or indirectly due to COVID. On average, practices reports 55% decrease in the revenue and 60% decrease in patient volume since the beginning of the COVID pandemic. Physicians are still working every day. They are trying to manage, they're trying to take care of their patient, they're trying to take care of their employee, but some of them are not getting paid. One of the endoscopy group, I think is in Atlanta, they used to do 300 cases a day, and now they're doing, 300 cases a week, now they're doing 8 cases per week. Myself, initially, Arizona did not get that many cases, but the governor asked us to stop elective procedures. So we were doing once a week instead of 5 days a week, elective procedure as an outpatient. And then in May 4th, he opened, so May 8th, we start doing 4 days a week instead of 5 days a week, but we were doing good, better, then suddenly it hits. This whole month of July, I'm doing only 1 day, which is next Tuesday, 15 procedures, otherwise no elective procedures, and it's affecting the practice. Obviously, financially, I'm not getting paid for last 2 months, and I'm the sole earner in that practice, and 9 employees have to take care of it. So we are all going through the same situation. And the surgeries are down 70%, 33% of office visit for surgical practices is down. Anesthesia services seeing the same decrease. So there are multiple angles that we have to look into how to survive this pandemic. The federal government have already started few programs. One of them is very well known, PPP, we call it, Payroll Protective Plan, or payroll. And they give you money according to the number of employee you have. And you cannot, if somebody making more than 100,000, they will only cut off his 100,000. And that money you can write off later if you keep the same employee and you use this money 60% for your employee salaries and 40% for other expenses. Then SBA has a loan, which we'll discuss, and I think my other colleagues will talk about those things. Then Medicare also pay us based on 2019 billing, 1.2%, which you already should have received in your accounts, where Medicare send you direct check. So if you're not, you have to call Medicare, or you can email, and it's very easy. It's called COVID-19 at cms.hhs.gov. So if you email, somebody will answer you, and you can figure out where that money went, because that is free money. You have to keep it. You don't have to return it. Then there is a Medicaid program. Certain states are doing it. Dr. Usmani will talk about that program. In Arizona, we have not received that. We received the federal funds, but the governor is not started yet. And Arizona Medical Association is pushing for it, so we can get at least some money for the patient that we see for public care or Medicaid patient. And telemedicine is a very good idea that they are paying you same reimbursement as you're seeing patient in your office. So that helps some of our colleagues. And there are sequestration, Medicare sequestration, if you may recall, they ended from May to December this year. So you will not be cut 2% that they were cutting before. So that's another. Then SBA, if you have not applied, go to sba.com. They will give you, no question asked, how many employees you have, $1,000 per employee. That is, you don't have to refund that money. And I already received it. And then there's another way to help is a loan from SBA, which is if you are practice, the loan you have to start paying off, I believe, next year, later next year, and it's 3.7, rather 2 years, so 3.75%. If it's a non-profit organization, is the interest is 2.75%. Again, you have to defer it until 2 years from now to pay off the loan. Lastly, the 401k, you can take out 100,000, up to 100,000 without penalty. Otherwise, you have to pay 10% penalty plus tax. So you can take out 100,000 from your 401k for personal use or your office use without penalty, and you don't have to pay tax if you return that money within 3 years. So you don't pay penalty, money is yours, and you can put it back tax-free again into the 401k. So with that, I will request our experts to suggest how to use 401k, what should we do with our retirement, because we have groups of physicians in 30s, 40s, 50s, 60s, 70s, and believe me, there are few in 80s also. How, I mean, if I'm 30-year-old, 40-year-old, I will not be worried about it because I have enough time to recover. But if you're in your 60s or late 50s or 70s, how to manage this environment with your 401k? That's a big question every colleague asks us. So I will ask the experts to answer this question, either Hank or Shiraz. With that, I will give back to Harun.
Gee, thank you, Dr. Kazi. First, I will ask Shehzad Iftikhar to give an opening statement, please.
Thank you, Dr. Rani. These are unprecedented circumstances. I think it's fair to say that this is probably the first time that we're all going through this. Let me start by painting a picture of how things were pre-COVID. Unemployment was historically low. Your investment markets, including Dow and S&P, were either record high or were touching record highs. We were coming off a strong year in 2019. The tax reform that happened at the end of 2017 had given the economy a boost, the markets a boost, and also the reduction in red tape and regulations over the last couple of years. That's where we were. The outlook was also very strong January and February this year. We were looking at an election year, and the possibility was that we're going to have another positive, economic positive year here domestically as well as globally. And then we hit the month of March, starting end of February, where the news became public and acceptable that this virus is going to have a long-term impact on our economy. And we went from seeing a record high in the markets to S&P 500 being down almost 34% within a matter of 30 days. Significantly lower, something that we have never seen before. We went from seeing a record high in employment to having an unemployment rate of 14.7%. Right now, the unemployment rate has recovered slightly, I should say. We've reduced that unemployment rate from 14.7% to 11% now. But we know that there's a long way to go. We also have seen the debt, the U.S. debt, as well as the Federal Reserve balance sheet increasing. Federal Reserve balance sheet, I think, was around $4 trillion towards third quarter, fourth quarter of last year. We're somewhere in the $7 trillion mark right now. And also in terms of government condition or where they're going to be or the anticipation this year, they're expecting tax revenue being one of the biggest sources. They're expecting to receive a 16% lesser tax revenue as compared to last year. So again, this is just a projection of where we were and where we are. Now, in terms of the impact of the virus, I would say it's been a global impact. It's impacted every sector. It's impacted the financial sector. It's impacted services sector, the healthcare sector, and every sector is dealing with it differently. But there are some commonalities. There are some common themes where you're seeing a loss of revenue. We are seeing a consistent reduction, I would say, in consumer confidence. And also, I think this is, at least in our opinion, this is becoming somewhat of a reality, that this is not a quick turnaround. We are expecting the turnaround, and again, it's based on conditions, but we are expecting the turnaround to take longer, 12 months, 18 months, possibly 24 months. Having said that, I think the impact on each industry is going to be different, and each industry has to cope and also come up with strategies on how they're going to deal with these new conditions.
Thank you very much. Next is Hank Bashor. Please give your opening statement.
Sure. Shahzad did an excellent summary, so I'll try not to be repetitive of what he covered. Something I'd like to maybe even take off a little bit from where Dr. Kazi was talking about 401ks. I think now this is a moment when you need to assess your own particular situation, personally, financially, as well as for your 401k or your pension plan, for you and your employees. You need to look and assess your liquidity needs. You need to look now, going forward, when I say liquidity needs, what are your cash needs now and even into the future? And then you look at your investments and say whether, okay, what happens if we have another big correction? Or what happens if we have more volatility and I need to get to my funds and the markets are down? And the likelihood of more volatility is definitely going to be around. We've seen a tremendous surge in the markets, coming off the March 23rd lows that we have never seen in such a short period of time. And we don't necessarily expect that to continue. We're actually getting close to where we were pre-COVID. February 19th was where we made those, we made those highs. So what one has to look at and say, okay, with the uncertainties that are out there now, am I positioned in my investments in too risky a fashion? Do I have too much in stock now versus being in bonds or versus being in cash? And even when you look at your stock, you can't paint a broad brush and say all stocks are the same. There's conservative, high quality core companies, and then there's very aggressive, fast growing growth companies. And if you're thinking, okay, I am too overweighted in aggressive stocks, you should think seriously about reducing that and moving more towards the high quality companies who are very resilient, who are have great balance sheets, who pay dividends, who even in corrections do not correct as much as the markets. So look seriously at that. Look at your allocation in stocks. Another is fixed income bonds. Most folks have not been in long-term bonds. Most have been in intermediate short-term, which is not a bad place to be. Short duration, we call it, or short-term income. And also look at the quality. Are you in high-grade corporates? Are you in government security? Are you in mortgage-backed securities? Are you in preferred stocks? Those are all desirable places to be at, you know, in volatile markets. So, you know, the words or phrases we use is de-risk. Look at de-risking your portfolio. And that merely means changing your allocation from being top heavy in stocks. You might have been 70, who knows, 60, 70%. You may want to bring that down to 30, 40, 25, depending on your liquidity needs. Investing is a long-term endeavor. As Dr. Akazi pointed out, if you're age 60 or 75 and you're not too far from retirement, you really want to bring down that, allocation to the more aggressive and to the, more volatile markets. Now, another thing to consider too, I've been in the business 38 years. I've been through 7 bear markets, and they're all a little bit different, but you know something? They also, history does sort of repeat itself. We've already had several, viruses in this country. I mean, going back to the Spanish flu, we've had some major ones. Same thing happened, markets correct, rebounded, volatility followed. And depending how soon the vaccine came out determined that. And right now, that's what's driving, believe it or not, driving the markets. The vaccine is a major thing. Every time you hear good news about the vaccine, it moves back up. So it's important to realize markets are predictors of the future. So remember this, when you see the market rallying and you're wondering, gosh, we have this high unemployment, we have, such large federal debt out there. Why is the market rallying? Because the market is looking out 6 months to a year from now and sees things getting better based on what the Federal Reserve has done and Congress has done. So when you base your decisions, base them on looking out in the future, 6 months to a year when it comes to investment decisions, and look closely at your asset allocation.
Very good. Thank you, Hanks. Before we open it for question answers, I'm going to bring in Dr. Shahid Usmani and Dr. Masood Akbar to give brief comments. Dr. Shahid Usmani?
I agree with Hank on a lot of things that you have mentioned. Basically, I just wanted a few things that, because these are some of the long-term things that we can do for our advice, our membership. But some of the APPNA members are having a hard time coping with the current situation because our practices have gone down at least 30 to 40% in most cases. We're not doing elective procedures like Dr. Kazi and Dr. Masood Akbar had mentioned earlier. So there are certain resources that are available to the physicians to manage the short-term. For example, some of the programs that Dr. Kazi had mentioned, like Sba Ebp Program, that is still open and physicians can apply for it. I want the experts to maybe elaborate a little bit on that. How do we go around? Most of the commercial banks are able to do it, but and then there are some of the bigger banks, they're not accepting applications. So there are other resources like smaller community banks and things like American Express and some other avenues. the EDL, which is the emergency disaster loan that is available to some of the physicians to manage their practices for now. For the PPP, we'll also like to elaborate maybe on the requirements for it to be forgiven. What should the membership do for that? Then with the Medicaid grant, Medicare had issued a grant early on to 1.2% of the 2019 Medicare billing earlier to all the Medicare recipients, but Medicaid had not had that. Now, on a statewide basis, Medicaid is also making a grant up to 2% of their 2019 Medicaid billing. So, and that in Florida, the deadline for application is July 20th. That would be tomorrow. So I'm not sure if a lot of, and that is just a grant, 2% of your Medicaid billing from last year. So that these are some of the things that are available. Some of the caveats that you might recommend in telemedicine for our membership, which is we are luckily getting billed, getting the same reimbursement for the telemedicine as we are for in-person visits, but there are certain criteria that have to be met for these telemedicine visits. So I don't know if you can expand on these, because that may be more very useful to the APPNA membership for managing our current situation. And once we get over this, I'll also like to maybe emphasize on our long-term management. How do we go around? There is some expectation that the stock market may not be as strong as it appears to be, because of all these programs that we have poured in $3 trillion into the economy, but that is essentially a debt owed to somebody in the long term. And then there's a few other, another $2 trillion that might be coming, so that the economy may not hold that strength later on. So I don't know if you have any comments on that.
Yeah, thank you, Rashad Bhai. Shiraz, I will just ask Dr. Masood Akbar to give opening statements, and then we will just open it for discussion. Dr. Masood Akbar, please. Dr. Masood Akbar, you have to unmute yourself. Okay. Well, I think maybe he's having technical difficulties. So we proceed. We can start our question and answer session, and I can start with my question. My question is to Hanks. Why are major market indices such as NASDAQ and certain stocks, for example, Amazon, Apple, Google, Netflix, why are they doing so good in the face of major economic bad news?
We are seeing a interesting phenomena that has repeated itself before, where, again, as I said earlier, you can't paint a broad brush against the whole stock market. There are companies, industries who are doing extremely well, and they have not even gone down during this pandemic. And, think of Amazon. Think of how well used Amazon is, in the stay-at-home economy. There are many companies out there who are benefiting from the stay-at-home economy. And those are the fastest growing companies in the United States, which mainly are technology, we call disruptors, innovator companies who are coming out with new ways of, doing things. Look at, what we're doing right now. We're all on Zoom. Zoom barely existed before this. Video conferencing has been around. Zoom stock has gone to the moon. It's gone up several 100% this year. Amazon has gone up a few hundred. I mean, Apple and Netflix, people are staying at home and watching movies and taking food out. So there are industries that are benefiting, and there's industries who are not. The travel industry, the cruise ships, airlines. So you are going to see a concentration, and that's the thing about the market. You got to be careful. In the NASDAQ, that is mainly the fastest growing companies, excluding financials. And there's only like 5 or 6 or 8 of the companies who make up the top 5 or 6 out of 100 stocks in the NASDAQ that are up tremendously. So the NASDAQ is positive this year, whereas maybe the other indices are flat to down. So be careful, realize if you're in the NASDAQ companies, it's making things look better than really what they really are. But those companies will continue to grow, and you should have some money there. I would be careful about putting a lot because it's already moved a lot. But that's why we're seeing this, this dysfunction where the NASDAQ versus the Dow Jones and other indices, there's a disparity, between the two.
Thank you very much. So now we open the floor for discussion. I just request to my panelists and the guests to just keep the comments short so that we can entertain as many topics as possible. I will ask Dr. Nadeem Qazi to please repeat the question which he posed first, initially.
Initially, I asked for what to recommend depending on the age-wise, and Hank did a very good job explaining it. And the message I receive is, first call your advisor, discuss with them your plans, your futures, and where you are. You have to review your 401k. I think that's number one. The other acute thing that we are facing right now, and we have to do something for now, is our practice. And telemedicine is one of a great idea, but especially like me, they come with abdominal pain. I have to palpate the belly. I cannot just see them on Zoom and say, okay, this is what you have. So I just did 3 Zoom consult. After that, I cannot do it. But some other primary care physicians, pediatricians, they can do it, and they should do it. And Dr. Usmani just asked how to bill. The billing is same. You just say F2F, there's a code 99421 between under 10 minutes of service, and 42 is 11 to 20 minutes, 20 minutes over is 43, which is the highest office visit pay. So that is how you bill, like exactly just your billing company should know. And every individual here who is in private practice or solo practice should discuss with their billing personnel, either in-office billing or if they are giving billing to some other companies. They should know how to bill all these things, because if you bill it wrong, you will not get reimbursed. So that's very, very important to discuss with your billing personnel. And other area that Dr. Usmani has asked questions. I mean, I'm not the expert, number one, but going through the Arizona Medical Association, trying to fight the governor to get money, I know a little bit about it. I will advise every individual, if they are in solo, if they are in a corporate medicine, they don't have to do anything, because the corporations, believe me, they are 10 steps ahead of us. They already received the government each and every penny, but the solo practitioner or small groups, they are the one who's getting hit bad because they don't have the organization behind them to address these kind of issues or get this money from the 1%. In your state, the Medicaid providers, go on their email. They have to answer you. Once your email is on record, ask them how to get this money. The government has given every state for the Medicaid patient also. Medicare we already received. And as I mentioned before, go and check your accounts. Back in March to May, did you receive anything from Medicare? It's a 1.2% of 2019. And there's another bill, which I'm not sure is passed yet. They want to give you the other insurance, which is beside Medicare and Medicaid, which is private insurance. I think 0.6% or so of 2018 billing. So that also, believe me, all these little things helps. I'm a solo practitioner. And if I don't have received this kind of support from the government and state, I have to lock down my office and say, okay, bye. I will do moonlighting here and there and survive. So this thing is helping. So, but you have to know how to get to them. So go on sba.com first, or org, sba.gov. Please go there. And also CMS, COVID-19 at cms.hhs.gov. Ask them question if you don't know. Ask your office manager to ask these questions. Get whatever is available. And again, the 401k that I want to ask, how the two experts feel if a physician require extra money to survive their practices. If they take out 401k 100 up to 100,000, the government said they will not penalize and they will not tax if they put it back again in within 3 years. What they think about it, because people then get scared, oh, if I remove and market went up, I will lose that money. So how to manage that issue, what the experts think about it?
Thank you very much. I think Dr. Masood Akbar, who was initially dropped from the Zoom, he's back.
Yeah.
I will ask Dr. Masood Akbar to give a comment or a question.
Ji, thank you. So I wanted to ask the experts as to if they can elaborate about
Masood Saab, either आपका phone and computer both are on, so it's giving us echo.
A little, yeah.
probably to mute one of them.
Yeah.
Is that better now?
Better, yeah.
Yep.
No.
Okay, just 1 second. I'll go on.
I mean, do you have to use both? If you are only going to use the computer, you can shut the phone off.
Actually, the problem with this computer, I had to switch that it was not, there was no webcam on it. So I think, is it better now?
Yeah,
Yes, it's better now. Yes, go ahead.
So the question was, I think if we can get guidance to all the members who did not apply for the patient protection plan loan, where could they have the resources where they can apply? So that was, Dr. Usmani covered the other question very well. So I think this is still something for general membership to know about it.
So, Hanks or Sharaz, you want to take question? Either one of you?
So I can take the question. You know, as far as the PPP program is concerned, the payroll protection program, it was introduced early on, and the condition was that if you were a business, you were you could be eligible to receive 2.5 times some of your monthly expenses, and the funding that you receive, you have to make sure that you utilize that funding for business expenses. Initially, I think the program was set up for 6 weeks or 8 weeks, and now the payback time or the return of the loan was extended to 24 weeks. Having said that, if you follow certain procedure, this loan can be forgivable. Another thing that I want to mention is you can also use this loan for employee benefits such as healthcare, as well as retirement plan contributions. So that was an amendment that came in where you could start utilizing the funding for that as well. The first source or resource you had to apply for the PPP was going to your bank, your local bank, and that still is the case, which is your starting point should be going to your local bank and asking them if they're participating in the program and if you will be able to submit an application through them. And then also with the help of your accountant, there's some information that's required that your accounting firm will provide you. So collaborate work between your, let's say, business manager as well as your accountant and your bank. You will be able to submit the application. Now we're at a second phase where now we're getting to a point where banks will start accepting the applications, which can then eventually forgive and make this loan forgivable for you. So you have to be very cognizant of the time. You have to make sure that the return or the information that's required by the government is provided in a timely fashion. Otherwise, that forgiveness part of it will not be available to you. So I would say that the first starting point is your bank. Certain banks are still participating. Certain banks don't have the funding or are not participating any longer. So I would say that's one of the sources. The other part of that, which was the 2019 Medicare fee-for-service reimbursement, or the FFS reimbursement. I think there's some. One, it was provided to majority of the healthcare providers, but there's some confusion on if it needs to be paid back. And from what our information is that there is no repayment that funding that came in, that stimulus funding that came in. As far as I want to address one of the things that Dr. Kazi asked, which was your 401k distributions. Going back to what Hank's point was you have to establish a timeline first, right? A 40-year-old can sustain a different level of risk as compared to a 60 or 65-year-old individual. So if your timeline is short, I certainly hope that you were invested relatively more conservative as compared to a 50-year-old, 40-year-old. One that would have reduced your losses in the market, and that also gives you the liberty to take a distribution if you need to. So, for example, if liquidity is an issue for the practice, and income needs to or revenue needs to come in, or liquidity needs to be provided to the business, your go-to is going to be this 401k. That's what the government has given you the privilege and the liberty of. But the fact is that you have to, first of all, establish a timeline and saying, do I retire in 5 years or 10 years, or am I retiring next year? Because based on that timeline, your decision can be very different. The second part of this is also what has the investment done so far? So if you're sitting at a 5% loss or 10% loss, that decision becomes very difficult. But if you're sitting in profit, particularly this year, then that decision makes it somewhat relatively easier. And last thing I'll mention is the difference between active management and passive management. So post 2009, there was a very popular phenomena that passive management is more effective, which means that if I invest my investments in the S&P 500, in NASDAQ, in Dow Jones, and take a handful of ETFs, then I don't necessarily need active management. I don't necessarily need an advisor, because advisor comes with an expense. Now, that was true for a number of years. We have seen an increasing or upward market trend for the longest period of time. But we started to see volatility come in the market 2 years ago, and particularly this year. And this is where you can differentiate how active management has outperformed passive management in a lot of different ways. And Dr. Dani mentioned the NASDAQ and said, why was NASDAQ up? That's part of active management, where you're picking and choosing which investment works and which investment doesn't work. And it's not necessarily only true with underlying securities. It is also true with managers. There are a number of managers that are positive in this market space in this particular year, and we're one of them. Where because of our active management style, our core satellite approach, investments have been positive. So I think there has to be a differentiation between how you manage your money and the advice of the advisor, even in terms of distribution, becomes very, very important.
I wanted to, can I add a little bit to,
Yes, go ahead.
To the 401k issue? And Shahzad, very well said, Shahzad. I agree with them 100%. On the 401k, Dr. Kazi was pointing out how you can take out 100,000. That is something to strongly consider, especially if it has no tax implications, no penalty implications, because one thing that we all should do is have a rainy day fund for this purpose, for this time. But believe it or not, you know, the market, the S&P is almost flat for the year. You know, it was up 30 some odd % last year. And if many of you have been investing for years, you have pretty good gains and profits over many years. So even if you were to raise some cash now, and maybe you're down 3, 4, 5, 6, 7% in your portfolio overall, and usually you're only down a little if you're well diversified. That is one thing too that I always preach, is diversification in risky and non-risky and income and international emerging markets. Diversify, because you never know which of those investment areas is going to underperform and outperform. But just right now, if you have a well-diversified portfolio, and even if you're top heavy in equities, you may be up or you may be down just a little bit. So raising this 100,000 is, you know, even if you take a little bit of loss, may be worth it, because what happens if we see another 10, 15, 20% drop? I personally don't think we're going to go down to the March 23rd lows, but we could head in that direction. So raising that 100,000, you know, especially if you're older, or especially if you're going to have cash needs because your practice has dwindled some, raising that 100,000 in there, whether you take it out or not, you know, taking out the 401k is not bad. It's more accessible, especially if no penalty and no tax. But raising cash, keep it in either low interest paying, short duration, fixed income securities, 1%, 2%, 3%, low volatility, safe, is not a bad place to keep it. Even if you put it in money market funds that are paying 0.2%, it's not a bad idea to have a certain amount of money in no risk. And that 100,000 could be that chunk of money. But a lot depends on how your practice is doing, your age, how close you are to retirement, liquidity needs.
Very good, very good. So I'm going to bring Dr. Shahid Usmani in to ask a question. Dr. Shahid Usmani.
I think that's well covered by Hank for sure. My question was, what do you think in the long-term prospect? Because we are accumulating a lot of loan as in these programs. Would that affect a long-term investment strategy? What do you, either Hank or Mr. Shiraz?
I'll throw something in there first. The market definitely looks for progress, for increasing returns, increasing sales, increasing dividends. Anything that's increasing, the market will be rewarded. The market has already discounted the amazing amount of debt that we have. They've discounted the fact that the Federal Reserve is there, to come in and rescue if need be, and it's been done globally. We all know the debt is tremendous. The markets know that. And what it is also counting on is that we're still going to see growth in our economy. Even the airlines, even though they're hurting, their numbers are picking up. So that's what the markets are constantly watching. So given the background in debt, to me, long-term, if you're invested in high quality companies that have little to no debt, who have great balance sheets, and you can look at the history and you put your funds, you can do this with a fund, put it through the stress tests. Look at the periods of time in history where we've had some shocks to the bond market, to rising interest rates. There are scenarios we can run, show you what happens in rising interest rates, rising inflation, in markets, the companies that make it through that, or the funds that make it through that, or perform well and beat the market, they're out there. That's where you want to be. So yes, the debt is tremendous. It's going to have to be chipped away. It's going to catch up to us if we're not making progress. Now, if we're not making progress, yes, then I think we're going to go into a depression. And I don't think that. I think we are making progress, albeit slow, and it's got to continue. It has to continue. The markets are watching this, so we will get a depression or a big bear market if our economy is not growing the way it should.
So if I can throw in my 2 cents, Hank, I'm going to be slightly contrarian on this subject. So far we've issued the debt this year, inclusive of this upcoming bill, equivalent to what the debt was issued in the entire 2 years of the Great Recession. So, to put things in perspective, we are now sitting at almost a $27 trillion gross public debt. The Federal Reserve balance sheet has increased and almost doubled just over the last 10 months. So are we concerned about that debt? Absolutely. If you look at the S&P, and not to become too technical, but the S&P is trading at 21 PE, right? PE ratio is almost 21. It was 19 at the end of last year. And it just shows you that the markets are more expensive. In terms of valuation, the markets are more expensive than where they should be. But also let's take a broader view and put again things in perspective. The markets, even at a 21 PE, traditionally are not as high and not overvalued, because historically, within 17 to 21, 22 is within the range where you can say the valuation is still fair. And certain companies and also European markets, for example, their valuation is much cheaper than what you'll find in the US. So US certainly is more expensive. And another point that was raised was also why are the markets up? If you look at the markets, NASDAQ, which is technology, I guess is a need of the day at this point, right? We've changed our behavior, our social behavior, even our business behavior now over the last 15 years, and become very reliant on technology. And based on the circumstances where we're quarantined, companies like Amazon, companies like Zoom have done well because it's the need of the day. And S&P, 30% of S&P is also technology. So remember, 30% of the S&P has gone up over the last 4 or 5 months, where the remaining sectors have come down, including real estate, manufacturing, and so on. But going back to the debt part, the debt is something that one has to be concerned about. Even if one says market is normally, or the equity market is normally 6 months ahead of Main Street, we still have to be concerned on how we've incurred this debt and what repercussions will be there at some point. I think the two factors that still are going to work in the favor of the markets, even with this increasing debt, is one, our inflation is low. So interest rates will continue to be low for a period of time. We don't anticipate that interest rates will go up at some point, will go up in the near future. And second, also the demand for dollar. Dollar has been the safe haven. So I guess that gives the government the liberty of printing more money if they have to, because there's still a very strong demand globally for the currency.
Very good. Dr. Nadeem Kazi, your question?
He answered very well. The question is, how much time do we have to make these changes recommended by Hank and also discussed by Shiraz? What time period are we talking about? Because that's the main question people ask us. When should we do it? I mean, right now market is quite up where we were. Actually, some of us are ahead. So what is the good timing to make those changes and make those decisions that Hank mentioned?
I'll jump in there. I'll give a short answer. Very soon, if not now, because as Shiraz said too, he was looking at the valuations of the markets. Historically, we're pretty high. We're not the highest. We've seen markets get, we call frothier than this, but you don't want to wait for that. So if you have some gains and you've been investing for years and you're ahead, I wouldn't wait very long. I would be an investor, because, the next big thing that's coming up too is the elections. And there's going to be a lot of volatility going into elections. And who knows, what's going to happen. The markets do like divided government, whether that means a Republican in the presidency and then the House is dominated by Democrats, or vice versa. They like some, division. But I would say timing is now to look at raising funds, because, like I said, I think the markets have done very well for several years. We've recovered off a really big hit, and valuations are high. I would be looking very soon. I'd be talking to your advisor, figure out your liquidity needs, look at your asset allocation, reduce the high risk, increase the liquidity.
Thanks.
So just to add to that, a great point, Hank, and I will echo that as well, that first of all, there are two issues that are being discussed here. Number one is the distribution. Should we take a distribution if we have to? In terms of that, I will combine it with a second point, which is how are your investments being managed? And based on those investments, do you have the liberty to take that distribution? Remember, retirement accounts are safe haven that should be reserved for retirement. Now, these are unusual circumstances. So if one has access to it and if they need a distribution, they should take it. But also, going back to the investment part, as far as your investments are concerned, your investments, if they're positive, possibly give you a liberty to take distribution. If they're negative, again, you have to look at your capital gains, you have to look at your losses and see, do I have the liberty of taking this distribution? Because again, all this will have implication on your taxes. In terms of the investments, I will say this, proactivity, and that's where active management comes in. Just to give you an idea, last year at our firm, we did 2 rebalancers in the entire year. This year, we've already done 3 rebalancers and reallocation, and we're possibly going to do 1 more before election. So in terms of the activity, we have doubled our activity this year as compared to last few years because it's the need of the year. Markets being extremely volatile. And to Hank's point, that's something that you need to discuss with your advisor to see how on an ongoing basis you're going to manage the investments. Last thing I want to touch on is the elections. Elections, there are 3 main issues that I think are concerned at this point. One, the number one is obviously the pandemic. When do we control it? I think that will dictate how the markets will behave. That will dictate how businesses will be affected. Will this be controlled within the next 3 months, 6 months, or will it really take 2 years to 3 years for us to control it? That's the number one concern. The second concern is the elections. Elections can go either way, and you have to assume that your portfolio is adjusted in such a way that it can handle the Republican Party being in the administration and Democratic Party being in the administration. I think one of the biggest, the 2 biggest differences from an investment standpoint and also from a business standpoint is, one, tax consequences. Republicans do follow a lower tax bracket formula, whereas Democrats, being more focused on social issues, tend to increase taxes. What we think that if Republicans come in, the same tax formula or implication will continue, where they'll continue to reduce their taxes. But if Democrats come in, the fear that they will immediately increase taxes, we don't think that is a concern at this point because of where the economic conditions are. Even if they do decide to increase the taxes, it will not be immediately. And as far as recovery is concerned, we are telling our clients, even as a business manager, that you should anticipate seeing a 20 to 30% lost revenue over the next 12 to 18 months. And one has to be prepared on how they're going to recover from that 30% loss. And I think someone mentioned the SBA loan earlier. I will say that if you continue to see a 30% loss in revenue over the next 12 to 18 months, SBA loans are available that could compensate and complement your business.
Thank you very much. We are, gentlemen, almost out of time. I want to give opportunity to everyone for a 30-second closing statement, starting from Dr. Nadeem Kazi.
I will just repeat to my colleague that make sure if you have not received PPP, go sba.com. It's very easy application. The calculation is difficult. That's where you need your accountant, because they will need your last year tax return plus last few months payroll ledger, and you just put the numbers. It will multiply, or they will give you equation. It will give you numbers, and within 2 weeks, 3 weeks, you will get that money in your account. Other thing, look into your state to get the fundings. It's available. Don't let that money go, because that's your hard-earned money. You're providing services without getting paid. I know many physicians who's not getting paid, so don't lose that money. And just for a correction, Shiraz, I did not mean to take money out of the 401k, that 100,000 or whatever. 100,000 you can, but not the rest of it. The rest of it money, people who is 55 and above, can they just keep it in a cash equivalent in the 401k for time being? That was the question I have. The 100,000 is free money because you're not getting penalties. And if you guys need any help, financial help, that's also very easy, because that's your money. You're not paying tax, you're not paying a penalty, but you have to give it back in 3 years. If you don't, then you have to pay tax on it. So that's a separate issue. But the Shiraz, the question was not about taking out money from 401k, putting into a cash equivalent until the market stabilizes, the older people like me.
Thank you very much. Thank you very much. Dr. Masood Akbar?
Yeah, I think it was very helpful discussion, and it is important that it's about time that we should have maybe 20% or 30% in cash, and we can always put it back in the 401k. But it's time, it was helpful to me that it's time that we should think about putting some of the stock funds into cash.
Thank you. Thank you. Dr. Shahid Usmani?
Thank you very much, especially Hank and Shiraz. You've been very helpful in eliminating the current situation that we're going through. But I would just request all our fellow members to be aware of all the programs that are available to help you in the short term. So because you still have to run your practices, you still have to go through the everyday, and it may last till the end of the year or even longer. And just inquire and get as much information on the SBA loans, the emergency disaster loans, the PPP, and the Medicaid grants. That is free money to you for your services that you have provided for patients who are unable to pay and all that. But look into the telemedicines if you haven't done that. For the primary care, especially for specialists, may not be a practical idea, but for most of the primary care providers, it is a worthwhile thing. Just see all the applications that you have. And the investment advice that, frankly, from Hank and Shiraz, I would request all the members to check with your personal advisors what they recommend. But I think if you're over 55, it's been said many times, I think liquidity is probably a better option to some extent. Thank you.
Thank you very much. Hank?
I think everything we've said about, de-risking is very important, but here's one thing I don't profess. I don't say completely get out of the stock market. If you have like 30% allocated to what we call large cap growth, maybe reduce that to 10, or small cap growth, maybe reduce that to 5. So that's what I mean by de-risk, because, the markets many times continue despite what we're worried about. We're all thinking, we're climbing, we call that that wall of worry. The other is cash. Cash can be short-term mortgages, variable rate mortgages paying 2%. So you go to cash or a money market fund, you're earning 1/10, 0.2%. You don't need to go there. It's okay to have some there. But the short-term, I've mentioned several times, short-term duration instruments out there, they're very low volatility. If you do a government mortgage, they're government backed. So that's one thing to consider.
Thank you. And Shiraz?
Thank you, Dr. Kazi, for that clarity. I think it's a longer discussion to see what your cash allocation should be. I personally think that, and this is the policy of our firm too, that the two-dimensional approach towards the markets, which is equity and bonds, is obsolete. You have to look at more alternative investments to bring you that security in your investments, protection investments, as well as the appreciation. But I just want to say two things. One, we are in an environment where we're going to continue to operate differently. We'll conduct our business in a very different way, at least for the next 18, 24, 36 months. And it's irrespective of the industry. So my message is that as a business, you have to think about efficiency. You have to look at being nimble and effective. Look at renegotiating some of the commitments that you have, either that's rents, your leases, your equipment leasing. Look into outsourcing. Whatever makes the program more efficient. I think one thing that also has to be said about healthcare is the use of technology. Now, we know there are the EHR, EMR, EMS programs out there, but the use of technology can also reduce the cost because you have to assume that there is going to be further pain in the market. And one last thing that I want to say is, and this is all, to all the viewers, that it's time like these that you realize the importance and the significance of organizations such as APPNA, AMA. You look at what HHS distributed in terms of that $100 billion relief fund. That would have not come without the efforts of majority of these organizations lobbying on the behalf of private practitioners as well as hospitals and so on. So in good times, we don't realize the importance of this, but I think it's important to realize the amount of work that these organizations do on behalf of their members.
Thank you very much, gentlemen. This concludes our webinar for today. There was a lot of information, and somebody for me, I think it's a lot to digest. And we're very knowledgeable, all my panelists and my special guests. Thank you very much. Khuda Hafiz. See you again in a couple of weeks. Thank you.
Thank you.
Thank you.
Very nicely done, Dr. Durrani.
Thank you.
Thank you, Dr. Durrani.
Thank you, Dr. Rani.
Thank you very much.